0-100 to 0-30. Hook. Quick question. Do you know the actual difference between an ETF and an index fund? Not the surface answer. The real answer? Most investors use the two terms interchangeably, and for most purposes they function similarly. But there is one specific scenario where choosing the wrong one can cost you thousands of dollars in taxes that you didn't have to pay. I have never seen a YouTube video explain this correctly. Today we're fixing that. 0-30 to 130. Intro. By the end of this video, you'll understand the structural difference between an ETF and an index mutual fund. And I mean the actual mechanism, not just the marketing copy. You'll understand why ETFs are significantly more tax efficient in taxable brokerage accounts and how that translates to real dollars. You'll know when an index mutual fund is actually the better choice. There are real scenarios, and you'll be able to make the right choice for your own situation using a decision framework we'll build together. Let's start with the definitions, because most explanations stop too soon. 130 to 330. The structural difference. Both ETFs and index mutual funds are investment vehicles that hold a basket of securities, stocks, bonds, or other assets, designed to track an index like the S&P 500 or the total stock market. The index being tracked is not the difference. The wrapper is. An index mutual fund, like Vanguard's VT-SAX, is bought and sold directly with the fund company at the end of day net asset value, or NAV. You place your order at 2 p.m. on a Tuesday. It executes at 4 p.m. Eastern when the market closes. The price you pay is whatever the NAV is at that close. An ETF, like Vanguard's VTI, is bought and sold on a stock exchange throughout the trading day. Just like a stock, you can buy VTI at 10:23 a.m. and get the exact price it's trading at in that moment. Intraday pricing. From an ownership standpoint, both give you proportional ownership in the same underlying securities. VTI and VT-SAX hold essentially identical assets. They're both tracking the CRSP US Total Market Index. If you hold both side by side for 20 years with identical investment amounts, your total return will be very nearly the same. So why does the wrapper matter? 2 reasons. Tax efficiency and minimum investment requirements. Let's take tax efficiency first because it's the bigger deal. 3:30 to 6 o'clock. The tax efficiency mechanism. In-kind redemptions. This is the part nobody explains properly. When you sell shares of a mutual fund, the fund itself may need to sell underlying securities to raise cash to pay you out. When it does, those sales can generate capital gains, and the IRS requires those capital gains to be distributed to all fund shareholders, even if you yourself didn't sell anything that year. This means you could hold VT-SAX for a year, make no transactions, and still receive a capital gains distribution in December that you owe taxes on. It has happened. It's not hypothetical. In 2021, many actively managed funds made large capital gains distributions as markets recovered and managers rebalanced. Some index funds were also affected. ETFs are structured differently. When investors want to sell, large institutional investors called authorized participants step in and handle the transaction, using an in-kind redemption mechanism. Instead of the ETF selling securities for cash, it exchanges a basket of securities directly for the ETF shares being redeemed. No cash changes hands inside the fund. No taxable event is triggered for remaining shareholders. This is why VTI has a history of nearly zero capital gains distributions. The ETF structure is inherently more tax efficient because it offloads the tax event to the authorized participants, who are often dealing in tax-advantaged institutional accounts, rather than distributing it to retail shareholders. The practical implication: In a taxable brokerage account, holding VTI instead of VT-SAX can save you from unexpected December tax bills. Over 20 to 30 years. This could translate to thousands of dollars in taxes paid on capital gains you didn't intentionally realize. 6 o'clock to 8 o'clock. When the index mutual fund wins. Here's where most ETF advocates oversimplify. There are real scenarios where an index mutual fund is the better choice. First, automatic investments without fractional shares. For most of modern investing history, you could not buy a fraction of an ETF share. If VTI traded at $227 and you wanted to invest exactly $100, you couldn't. The mutual fund equivalent, VT-SAX, allowed you to invest any dollar amount down to the penny. At most major brokerages today, fractional ETF shares solve this problem. Fidelity, Schwab, and M1 Finance all offer fractional ETF investing. But if you're at a brokerage that doesn't support fractional shares, the mutual fund wins for automated contributions. Second, 401(k) accounts. Most employer 401(k) plans do not offer ETFs. They offer institutional share class mutual funds, often the same index being tracked, at an even lower expense ratio than the retail ETF equivalent. In a 401(k), the mutual fund is almost always the better option because 1. Tax efficiency doesn't matter. Accounts are already tax-deferred or tax-free. And 2. The institutional expense ratios can be lower than the retail ETF. Third, investor behavior. Some investors benefit from not being able to trade intraday. If you're prone to emotional selling during market dips, the mutual fund's once-per-day pricing removes the ability to panic sell at 10 a.m. and regret it by 2 p.m. The friction is a feature for certain psychological profiles. 8 o'clock to 10 o'clock. VTI versus VT-SAX. Head-to-head. Let's make this concrete with the most popular comparison in this space. Show comparison table. VTI. Vanguard Total Stock Market ETF. Expense ratio. 0.03%. Minimum investment. Price of 1 share. Approximately $226 as of 2025. Tax efficiency. Excellent. In-kind redemptions. Intraday trading. Yes. Fractional shares. At most brokers. VT-SAX. Vanguard Total Stock Market Index Fund Admiral shares. Expense ratio. 0.04%. Minimum investment. $3,000. Tax efficiency. Very good. Vanguard uses a patented dual-class structure that gives VT-SAX ETF-like tax efficiency. This is unique to Vanguard. Intraday trading. No. Fractional shares. Yes. Any dollar amount. Important note. Vanguard is unusual because of a patent that has since expired. 2023. VT-SAX effectively shares the same underlying portfolio as VTI and uses a mechanism that makes it nearly as tax efficient as the ETF. For Vanguard funds specifically, the tax efficiency gap between the ETF and the mutual fund is much smaller than with other fund companies. At other providers, Fidelity, Schwab, and others, the gap between ETF and index mutual fund tax efficiency is more significant. A Fidelity or Schwab index mutual fund does not have Vanguard's patented dual-class structure. 10 o'clock to 11:30. The decision framework. Here is the decision tree that should guide your choice. Question 1. Is this money in a tax-advantaged account? 401(k), IRA, Roth IRA? If yes, go with whichever has the lower expense ratio. Tax efficiency is irrelevant inside a tax-advantaged wrapper. If no, go to question 2. Question 2. Is this money in a taxable brokerage account? If yes, generally prefer the ETF. especially if you're at a non-Vanguard provider. In-kind redemptions provide meaningful tax protection over time. Question 3. Do you want to invest a specific dollar amount automatically without worrying about share prices? If yes, and you're at a provider without fractional ETF shares, use the mutual fund. If yes, and you're at Fidelity, Schwab, or M1 Finance, use the ETF. Fractional shares solve this. Question 4. Are you invested through an employer 401k with institutional share class mutual funds? If yes, use whatever the plan offers. Expense ratios on institutional mutual fund classes are often comparable to or lower than ETFs. For most people watching this who are investing in a taxable brokerage account, ETF is the default right answer. For most people investing in a Roth or traditional IRA where tax efficiency is already handled, either works. So default to whatever has the lower expense ratio and whatever your broker makes easiest. 11:30 to 12 o'clock. CTA. The short version. ETFs win in taxable accounts for tax efficiency. Mutual funds win when you need precise dollar amount investing without fractional share support. And neither matters much inside a Roth or traditional IRA. The expense ratio is always worth checking. I've linked Vanguard, Fidelity, and M1 Finance in the description. All three support fractional ETF shares for automated investing. If you found this useful, subscribe. I post 2 videos per day on personal finance with real, specific explanations, not buzzwords. Comment below which account type you're primarily investing in, taxable or IRA, and I'll make sure my future content hits what you actually need.